the earlier you look at the valuation, the more time you've got to work on it, and the more you can prepare, the more you can compound your returns.
This podcast is for informational purposes only and does not constitute financial, legal, or investment advice. Please consult a professional advisor before making decisions based on what you hear on this show. Wealth Without Wall Street Tribe. I'm excited to introduce Mr. Saul Cohen. Saul, welcome to the show.
Hey, thanks for having me on.
So a business owner right now is riding down their road, envisioning what their life's going to look like 10, 15 years from now once they get to exit. Unfortunately, most of them make the mistake that maybe even your dad made by not having somebody like you in their corner. I want to break that down, if you don't mind. What are some of those things immediately that this business owner needs to know and stop and take the next 20 to 30 minutes and listen to you for?
Okay. So I think the first thing is to appreciate that the difference on exit is in the hundreds of thousands, if not millions, right? And the more successful your business is, the bigger the difference is going to be, right? So whoever you are, whatever business size you are at, this is going to make a material difference to your life. I think the second thing is it's about knowing the journey that you're on and being conscious about that journey, right? If you're running a lifestyle business, you need to make sure that you're building assets, tax efficient assets in the background that are hopefully compounding over a number of years, right? And I know I'm on the right show to be talking about compounding and the effect of compounding, right? It's huge. And when you think about tax efficient compounding, the difference is even bigger, right? So if you're building a lifestyle business, you should know that you're building those assets. And if you're building a business for an exit, then you need to appreciate the fact that you're going to be investing in that business. It's going to take, time and effort and sometimes money to build the assets that will increase your valuation.
Oh, so good. I'm excited to hear how we unpack this today. One of the things, though, just to kind of get us kicked off, I was talking to you ahead of time about this, that there's like a unique time in history that you feel like today people need to be paying attention to this space, in particular, the prospect of exiting their business and or people trying to buy into businesses. Talk a little bit about why you think today is such a big opportunity.
Yeah, so I think today we have this boomer generation, right? And the boomer generation, they've had a massive economic impact on every area of the economy that they touch. And like with every other area, there are lots of entrepreneurial boomers who are now approaching the stage of their career where they're looking for retirement. And I think that means that more than any other time in history, we have a really large number in the population, a large amount of the population, on the entrepreneurial population, coming to exit their business at a time when the number of entrepreneurs coming into the market and the workforce coming into the market is inherently smaller than the numbers that are coming out of the market. And that means that's creating a tension. It's creating a competitive edge. And what we see is, you see these statistics being batted around all the time. 85% of businesses don't sell. It sounds crazy, but I have personally seen that. I've seen, small successful businesses maybe making 100,000-200,000 pounds a year. I suppose in dollars, it's 200,000, 250,000 even dollars a year. And instead of being sold off for an amount of money, they're closed down, the lights go off, and that's it. Employees are made redundant, game over.
How many summers do you have left with your kids? 10, maybe less?
And are you spending them together, or are you still stuck in the office while time slips by?
You want freedom. That's not the problem. The problem is you don't have a system that buys back your time. Without it, 3 years from now, your kids will be older and they won't care that your business was more successful. They'll remember you weren't there.
That's why we built the Passive Income Operating System, the plan we use to create over $50,000 a month in passive income. The system isn't free, but the training that shows you how it works is, and it's under an hour.
Go to wealthwithoutwallstreet.com/PIOS. Take the first step to buying back your time now.
I want to dig into that, like why that is, but I also want to touch on, like, my wife is like, keep seeing businesses being scooped up by private equity, and she's asking me why that is. Like, and I'm trying to give her my opinion of, I believe that the private markets are producing greater returns than the public markets, but are you seeing that? Obviously, you have clients both in the UK and the US. I want to like talk a little bit about this because we have an international audience as well, but most of them primarily in the US. What are you seeing as drivers to the private markets buying and scooping up these companies? But also at the other end, going back to your point of why are companies who are profitable not able to sell?
So I think that those 2 points are really related. I think that, and it comes down really, actually, let's talk about valuation, right? Let's talk about how you value an SME business, right? An SME business is valued as a multiple. Generally, it's valued as a multiple on the on the income, right? And the reason why we do it that way is because we say that the assets that this business owns can generate income at this level of risk, right? So if I break it down another way, the income that the business produces has a level of risk. That risk is given a multiple. It's got an inverse relationship with that multiple. The more the risk goes up, the lower the multiple is, right? Now, in the small businesses, they tend to be really risky. When they're really risky, they have lower valuations, and the owner is generally deluded a little bit because they've not had advice. No one's explained to them what their business is really worth in advance. So they weren't able to build up those assets and make their business less risky to an investor. An investor is looking at this very risky acquisition that an owner wants an extortionate amount of money for, and it becomes very hard to do a deal. However, when you can do a deal, the deal can be on really great terms. The deal can be at a much lower valuation. And if you have the ability to put, let's say you can put 10 of those together, you've now, just by the fact that you've got more size, you have a less risky business and the multiple changes, right?
Yeah. Well, and I'm actually, as you're explaining this, so I'm seeing this from both sides of the coin. So we have some people who are business owners who are listening to the show are saying, man, I need to take advantage. I don't want to be that guy. I want to be on the opposite side where I have fixed these issues that I didn't realize were keeping my valuation down.
Yeah.
But there's also the other side of the coin where somebody is saying, I really want to get into business ownership because I know that there's true wealth that can be built in an operating business. And I may have a really unique time in history where I could get in at almost like some basement prices because people aren't aware of these known things that are keeping the valuation down. But that begs the question, what are those things that you just immediately see out of the gate that people like us should know, but we don't? Like the business owner is missing these key things.
Can I simplify that question? Because I had that same exact thing. What are those components that reduce the risk?
Um, it's the quality of the assets in the business. And so an asset in the business might be a process. It might be, the reputation that the business has in its industry, and it's the demonstrable quality of those assets, right? So, for example, let's talk about reputation, right? A reputation will be really good if my name, so my business is called The Expert Eye, if you can see that lots of people know The Expert Eye and are looking for The Expert Eye and come into our website, for example, and request meetings with us, that's a valuable asset, right? Our website's valuable and our reputation is valuable, and we can demonstrate the fact that it's valuable because of the fact that we're getting leads in. People like to refer to us. We've got really good ratings on Google, for example, Trustpilot, whatever it is. We can demonstrate that we've got a really good reputation that you can leverage. If you can't, the problem is that with a lot of a lot of business owners can't demonstrate the fact that they've got really good assets. And normally it's
Well,
because
hold
it's
on.
in their head.
Let me pause you. Let me pause you. So but the business owner's saying, well, Saul, I mean, you can see my revenue over the last 2 years has been good. It's growing. Why do I need to have some third party something that proves that I have a high reputation? Don't my numbers speak for themselves?
I love that when business owners say that, because it just shows me how humble really they are. Right. because because you know what, that if they were making an acquisition, and sometimes, by the way, when we've got enough time with a business, when someone comes in for an exit and we've got enough time, we actually coach them through an acquisition, because it's really useful for them to get in that headspace. And it does a whole load of other things as well, but it's really useful to get in that headspace. Business owners are really smart people. If they were making those acquisitions, particularly, they're successful, they've been through their career. If they were making that investment themselves, the first thing they would say is, "This is all in your head." You know, this business is really good because it's a reflection of you, and you are fantastic. And if I take you out the equation, the business falls to pieces. Or even if it doesn't fall to pieces, it definitely doesn't continue in the way in which it has done for the past 10 years or 20 years or however long it's been running. And the only reason they do that, when they're selling their own businesses, as I say, is it's their own humility that they really do underplay the size that they've got, the relevance that they have.
Well, it is good. I love that exercise. And by the way, we're in acquisition mode, and through this process, we're learning all the mistakes. Right, we're making all of the paying full retail for all the mistakes. But also, it is in the back of our minds because, yeah, I believe it. Either it's a lifestyle or you're preparing for exit. It doesn't matter if the exit is in 12 months or is in 12 or 24 years, right? Like the point is that you should always be either A, knowing that it's a lifestyle hobby, or B, knowing that it's preparing to exit. And so as we go through this process ourselves, I'm like, oh, that makes total sense. Like that's something we have to rectify. So what are, those processes? What are those systems that you're helping those people go through those exercises to understand I have to have those so that my business is valuable to an outside investor?
Right. So I'm an accountant, so it won't surprise you to know that the first one that we do is the financial the financial processes and controls. The reason why we always put that at the front is because it allows us to track the progress that we're making, right? And it allows us to track accurately the process that we're making and make sure that we are making decisions based on fact and not on opinion. The next thing really is going to be to make sure that we've got a good sales process that operates without the owner. Generally, most entrepreneurs that we come across, they're fiery, they're driven, they can sell their product, and so they are the ones that sell the product. And so if they can come out of that to a certain level, and demonstrate that the business makes sales, the business gets referrals without them, that's massively powerful. And then it's the operational side of things, but generally the operational side of things isn't as big as the referrals, because, as I said, most business owners hate the operations.
So I want to go back to the first one then that you said that you guys specialize in when it comes to financial processes and controls. How big does a business need to be to start, implementing these things? What does that look like? Is it bringing in a full-time comptroller, CFO, or is it a fractional person? Talk a little bit about that for the person who's like maybe have been handing this off to some maybe bookkeeper or maybe their accountant's been helping them with this. What are some of those financial processes and controls that need to be implemented?
Yeah, I think it's great. For me, the main thing is to have a management control process. An end of month process. So where you've got a financial controller coming in at the end of the month. So that is sort of I suppose you'd say like an accountant, to come in at the end of the month and make sure that your balance sheet is accurate, right? That's what they do. They check through to make sure that the balance sheet is accurate. If the balance sheet is accurate, generally the P&L is the movement in the balance sheet, and so the P&L will be accurate. And it does a full check, basically a reconciliation of every single line in your balance sheet, and that is massively valuable because it means that the P&L and the balance sheet that you're presenting at the end of your month, the KPIs, the key performance indicators that you're looking at, are really accurate, and it means that you're looking at it on a monthly basis. That to me is the baseline. I think, and to be honest with you, I think that people rush to get finance directors and CFOs before they have that process in place. And actually, I think that process is the foundation on which a finance director will operate and a CFO will give value.
How much passive income do you have right now? And if in 5 years you're still at the same point, what's that going to cost you? Maybe more time at a job you hate or missing moments with your family?
See, most people don't move because they don't know what to do. So they just keep doing the exact same thing.
That's why we built the Passive Income Lab. It's a 12-week program where you are guaranteed your first $500 a month in passive income.
But here's the catch. It's not open to everyone. We only let in 10 people at a time.
So the real question is, will you be one of them? Apply now at choosepassiveincome.com.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
So you're saying that people are jumping to an end that is not necessary before they actually go ahead and they just need to get this foundational key aspect that may be a lot less expensive to bring on board, but they just assume that they need the full kind of Cadillac out of the gate.
Yeah, I think it's look, business owners you don't know what you don't know, right? And when you're starting a business, and even for myself, when I started my practice, no one teaches you these things, right? And so business owners are not accountants, and they don't understand what an accounting function looks like. So they just think, I need help with my finances. I'm not getting it right now from my accountant. I need a CFO to come in and tell me what to do. And that's why they do it. But the truth is that really what they're saying, if you get into the underlying, what's the emotion driving that, is they know really that they're not getting the data they need from their business. They know that something's wrong. They can feel it. But they're not really sure what it is. And for me, it's that piece first.
Well, I mean, I equate driving your business without dashboard, especially the financial ones, like driving a car without a dashboard, right? Like, I mean, you might think you know how fast you're going. You might know, if you have gas or not, but there are a lot of times I think you're blinded and you're prepared for a crash, right? So I do want to shift this to, your expertise. Obviously, you come from a Big Four accounting background. People come to you as a consultant to help them prepare for exits. What are some of the top 2 or 3 things that you normally see in somebody's business that are problematic, preventing them from getting to the next level that we haven't already addressed, like reputation and sales process and so forth?
Do you want the top one or the easiest to fix?
Well, maybe you could tell us what the top ones are. Obviously, it sounds like those probably are maybe deeper than a podcast conversation. Then you can tell me the easiest ones to fix.
Okay, the biggest one is always going to be the reliance on the owner, right? That is by far and away the biggest issue. It's the hardest to fix. It takes time, it takes effort, it affects every other area of valuation, and it is massive, and it does take time, effort, and money actually to fix that. The easiest to fix are going to be things like getting the finances right. And you might turn around and think, oh, but the finances isn't going to affect my valuation, but actually it does, right? Because I've seen deals fall down because the buyer has lost faith or the investor has lost faith in the financial reporting being presented to them. They're just like, well, you're not on top of your numbers. You're not on top of your numbers. I'm not interested in this deal. Right. I've seen that happen on multiple occasions. And I've seen occasions where we've come in, put the finances together, demonstrated, adjusted EBITDA really clearly, and actually the valuation's gone up because the numbers have been presented really clearly, and it's showing that there's less risk in this business, and valuation increases. So the finances is probably one of the easiest things to fix. I think contracts with your customers and suppliers is another really sort of, is actually quite an easy thing to be able to deal with and to fix. It's the sort of thing you can sort it out in 3 months. And if you've got contracts, most businesses have some kind of repeat business, and if you could turn that repeat business into sort of recurring revenue of some kind, that's going to make a huge difference for the multiplier. But even if not,
Just to clarify what you meant by that, you're saying a lot of business owners are operating with these kind of recurring revenues coming from repeat business, but they haven't formalized them into some sort of a contract basis. So the new buyer is kind of like, well, I see the revenue. You're telling me that there's this kind of consistent income, but it's not really in a way that they can kind of, look at it and feel good about it continuing.
exactly. Yeah.
You're just saying spend the time to build those things in, and that increases your, the confidence of the buyer.
Yeah, exactly. Have a contract with your clients that gives you scope to create price increases, inflationary price increases every year for the next sort of 5 years. Wow. When you've got that kind of contract, how much does that reduce the risk for me as an investor? Even if we don't get any new business, I'm confident that this business is going to continue in the way it has done because you've contractually tied down all your clients.
One of the questions I've had friends ask me, because we've talked a little bit about, our business and being approached by private equity. And one of the questions people said is, where do you feel like we are in the market cycle? Like, do you feel like that these multiples are, over exaggerated at this point, or are they compressed for some reason? What is your opinion of that? And what makes those move, or what are the biggest drivers to those? If all things else being equal, all processes, all systems, all of the, the things that you've talked about that's reduced risk are available to companies, where are we at in the market cycle based upon your time frame, your experience of doing this for so long?
I think that actually the world is has been quite different in the past sort of 5 years since COVID. And because we've seen a lot of sort of like mini cycles, I think, in that time. And it does seem to me that the world's quite different. And what I mean by that is that it's less that the overall economy has a cycle and more that industries are going through cycles. And for example, not long ago, dentistry, if you had a dentistry practice, people were getting 12, 13 times multiple on income in a dentistry practice. It was insane. And the reason was that private equity had come into that market, decided we're going to wrap up in the dentistry industry, and that's what we're going to do. Right now, I think it's sort of been sort of landscape management, right? That's been the next sort of big thing. The private equity are coming up, they're buying up all these big landscape management businesses. They'll do their wrap up, they'll sell out eventually, and then it will be a different industry, and the multiples in that industry will go back down to normal. And so there is that. I think that right now, actually, it's more just in terms of industries are having the flavor of the day. I also think that actually there's going to be a lot of liquidity coming into the lower end of the market and coming out of the upper end of the market. When we think about the fact that a lot of boomers are now retiring, well, what's happened? they had money in their pension pots, right? So the pension funds were investing in large equities at the higher end of the market, and now they're going to be drawing down on that money out of and taking it out of the big equities and moving it around this lower level of the economy. And so actually I think there is going to be quite a big transfer of wealth around, but I think it's hard to say yet where exactly that's going to play out.
Can you give us even like a small example of what you mean by that transfer happening? Because I'm trying to follow exactly what you're saying, but I want to understand maybe a little bit more practically what you have in mind.
Okay, so let's say we had a boomer who'd been paying into their pension pot for the past, 40 years. That pension probably been invested in, let's say, the FTSE 100 or the S&P, and that had increased that had really pushed those indexes forward over the past 40 years. If you look at the growth in those indexes over the past 35, 40 years, it's been insane. It's been crazy. But I think if you think about what's going to happen over the next 10 years, well, those people, those boomers, are going to start drawing down the income from those schemes. So the investment in those markets are going to change. It won't, I don't think we'll see the same level of growth that we've seen in the past 30, 40 years. And I think actually what they're going to do is that money will be invested into, you know, care homes, which is why care home multiples are going up at the moment. It's going to be invested into holidays and other things that the boomer generation are going to want to spend their money on. And I think that has a massive opportunity generally for SMEs.
That makes a lot of sense. By the way, I love that you called them schemes, because any of these, Wall Street backed deals are schemes at the end of the day. So thank you for telling the world that for us. Uh, what other trends do you see? So someone that is looking to get into, I want to kind of touch both sides of this. Someone who's looking to buy into a business right now, is there any specific industry or any specific vertical that you're seeing has maybe some of the best opportunity to get in on? Or is it just in general? Like, I'd love to know if there's any specifics that you'd share.
I think there are a few. I mean, actually, IT services is one of those. Just general. But general consulting businesses are a real hot topic at the moment. I mean, some investors are quite spooked from them because of AI, right? And they're worried about how AI is going to affect the consulting industry. But I think you got to remember that lots of boomers went into consulting, so there are lots of sellers in those markets selling really successful businesses, and not all the bottoms. While it's a big opportunity, there is quite a lot of risk in there, and so there's less buyers. So for those who choose that market, there is quite a lot of opportunity there. I've seen some absolute steals of deals going on, like really favorable terms, big deferred considerations.
Well, Saul, this is been very incredible. I appreciate you sharing your expertise. For those listening and want to connect with you or explore maybe small business investing further, what's the best way for them to reach out?
Yeah, I mean, look, I post on LinkedIn sort of every day, every week. So absolutely on there, there's a ton of value.
Well, I know also you were kind enough to share some sort of consultative call for the right person, and we created a page, wealthwatchwallstreet.com/business valuation. That way it's easier than the long link, but you can go in the show notes and click that. Who's that right for, right? Who should do that? And like, who's the ideal person that you guys could help? Because obviously we want to be a good steward of your time, but also the person listening.
Yeah. So it's a valuation power call. And what we do in that business is in that call, sorry, is we go through a sort of a deep dive into the business, the economic drivers of that business, and see what the three big drivers are going to be for the valuation in that business. So you've got an idea of what you can do to sort of build that business and build the valuation. The ideal client for that is someone who is sort of, I would say, up to 2 years away from an exit. Look, it's one of those where the earlier you look at it, again, it comes back to that compounding piece that we spoke about at the beginning. The earlier you look at the valuation, the more time you've got to work on it, and the more you can prepare, the more you can compound your returns. But really, we do our consulting. We do mainly with people who are sort of 5 years out. But again, the more time that we've got with people, the more opportunities that we've got to change to move the needle. And with people who are sort of 7-8 years out, we've got the opportunity to make acquisitions and do other fun stuff. So I would say, if you run a successful business and you are concerned about what happens after this business doesn't exist, because we all exit our business one day, it's just a question of how, then that call will be of huge value to you.
Excellent. Saul, thanks so much for being willing to come on and share such great nuggets with our audience today.
Thank you for having me on. I've loved it.
Yeah. And Tribe, if you got value from today's show, if you'll do us a favor and just comment anywhere you're listening to us right now, let us know if this is something that you're looking to get more information on. And also do us a favor, share this with somebody else, another business owner, friend of yours who has had some of these same concerns or has not even considered these things because they didn't even think about the impact of what it could have on them. And so we can help them on their road to financial freedom. Saul, thanks again. And Tribe, will catch you on the next episode.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.